Hi, Larry Berman here, and not only here's what's on my radar, but here is my radar. And as you can see, late Friday afternoon, a lot of red on the screen. There is some green you can see there with gold shooting up. There are some of the headlines that have crossed in the last hour or so related to border movements and warnings on an imminent attack of Russia and Ukraine. If you look at the RSX ETF that represents Russia, obviously under pressure for a number of months now, but that big red candle there today is today's price action. If you look at all the flight to safety measures, you can see our trade blotter is here. Let me bring that up. I'll give you an example of one of the trades we made today, but you can see here we own some Valero. We had actually sold out, and I replaced it with a June put at 75, so happy to buy it back position-wise. I'll take a little more than 3% premium, and I'll sell into the strength here. Those are a lot of the things that we'll look to do and to try to take advantage of this market volatility, but it's certainly combination of every 5 minutes someone else has an opinion on what the Fed should or shouldn't do in terms of policy, in terms of tightening. We heard Bank of America today comment on a much more aggressive Fed and $1 trillion unwind this year and another $1 trillion next year of the balance sheet. I think these guys are completely out to lunch. Yes, educated, yes, smart people, all that. There's no chance the Fed can unwind anything. There's so much leverage out there, it's staggering. So, slow and measured is what the Fed's going to deliver here. And I really don't see any other way there. And the market's priced or starting to price much more aggressively for that. And the bottom line here is that earnings are okay. I suspect maybe 3,800 is the downside test, worst case scenario. So from where we are now, it's pretty notable. It could another 10 or 15%, but we're not talking about a market collapse here. Now, there's all kinds of scenarios that we could get into that. Best idea here is that you're going to see failed rallies. So the highs are in for the year. I can't imagine a scenario where we go higher. And that's the environment you've got to trade in and learn to navigate this year. It's no longer buying the dips, it's selling the rips. And you want to be in low PE stocks. If you kind of look at the names on our radar here and you look at their PEs, the names we want to buy into the portfolio right now are the ones that are a little bit oversold, where we've got some good upside to the price targets. Their current RSI readings are in the oversold camp. You can see there on the end of on the board. So we're looking to buy oversold names, low PEs. I scan across here and look at a name there. Meta Platforms, Facebook, wow. Down 3.6 at the moment, trading at 15 times forward earnings. Price target, 335. Well, I don't believe that for a minute, but in the 150, 170 range, Facebook is attractive here. So that's a name on our radar right now. Listen, I hate the company. I think the owner is a bit of an idiot. But besides that, if I'm going to trade that name, it's starting to get interesting from a value play here. But I don't like it at this level. And a lot of the big tech names, there's Netflix right above it, falls into the same category. Right now, I own Baidu. You can see the position there. It's a little over 0.5% in my stock portfolio, 1,600 shares. From where we bought it on average, it's up 11.6%. Bull and bear picks here. Again, look for names that are oversold, low PEs, that have good fundamentals. Those are the names we're buying into our portfolio, and we're just avoiding everything right now that has a high PE or is very speculative. That day will come back again, but it's not until the Fed really sets us on a path here. Could be sometime in 2023 where we start to look at big PE growth names. Until then, I think they're all failed rallies. Have a great week, everyone.